Now, before we get into some of the specific U.S. economic data, we just want to look at what is the change in real GDP by percentage points. So this was a great chart that I came across on Twitter. As between Twitter, the Daily Shot, some of these others, you can find some great information. And the two individuals at the bottom, Liz Ann Saunders is fantastic. You know, she has been great in terms of getting some of that data out there. But when we look at, you know, what has happened in contrasting, well, okay, what was the financial crisis, peak to trough, and what has been the COVID pre-virus to current? And I think it's interesting to see what the impacts are. So in the US, it's fairly consistent. So right now, we're right around those levels in terms of peak to trough. And it's really, if you consider the amount of, you know, federal Fed in impacts, the amount of stimulus that came out, you kind of get that indication. The bigger issue, which I like to point to, is India, Spain, and the UK, specifically India. So the impacts of COVID has been a huge problem, and which is why when we talk about India, China, and some of the geopolitical issues and what can happen going forward, it's important to appreciate just how impactful COVID was for some of these other economies specifically. And then if you thought Spain was bad during the financial crisis, obviously it's, you know, here we are. And this is going to be the overarching issue, is some of these emerging markets are getting hit much harder from COVID versus the financial crisis. And that's something that needs to be appreciated, especially as we think about a recovery and where do we go going forward, which is why we want to look at poverty in a bit more detail in terms of, well, how much damage was done in terms of cost of living versus, you know, total amount of income, which is going to be a problem. In the US, you can see is fairly balanced as we go forward. And then obviously Japan is just essentially, you know, the BOJ owns everything. So there wouldn't be too much of an issue versus some of the others. Now, if we look at the Fed's large footprint, you can see that the ratio of Fed Treasury holdings to total marketable treasuries is at an all-time high. We're now just a little over, I think, 22% or just below 22%. And the trend is up. Yeah, this is something that's going to continue as the Treasury issues, the Fed is buying. So this is something that we continue to see the slope. Obviously, it's not going to be this massive move higher, but the slope is going to be that 45-degree angle, because let's just assume the Fed's buying at a VWAP, and there's just going to be that you know, essentially a Madoff return for the Fed as everything goes up and to the right. But as we look out and look at the U.S. budget, so the U.S. budget deficit, so when we think about, you know, the Treasury issuing to close the gap, the Fed buying as some of these countries, as the foreign purchases start to slow down, you continue to see this, you know, where we sit at this point in time. So the U.S. budget deficit tripled to $3.1 trillion in September. It now accounts for 16% of GDP, which is the largest since 1945. So the expectation was that it was going to actually be a little bit larger. So the fact that it wasn't larger is less about that we took in more tax revenue, and just there's been a continued delay on new stimulus. So the expectations when you were considering why the estimates were for a bigger deficit, it was the expectation that the thing that we're still fighting over on a political level of, you know, will it come before the election, now after the election, that was factored in, which is why it surprised, you know, less. But again, regardless of who wins the presidential election, we have more stimulus coming. And that's something to consider when you look at just the budget deficit, as it's going to only increase at least through, 2024, 2025. I mean, you put a number on it, and that's probably where we're going to continue to see those deficits run. Now, just looking at some of the weekly data, you know, when we look at the weekly economic data from the New York Fed, you see it pulled back a little bit. It's now at a negative 4.2% in terms of kind of where we sit. It was initially getting a little bit worse. It got a lot better from, you know, negative. Overall -6 to negative almost 3.7, and now it's starting to pull back, and it's not so much because there's a huge, again, overhang where this is going to be the biggest problem. It's, again, kind of capping us in this level. You see industrial production year over year under it actually surprised to the downside. and again, just this general activity. Now, the retail sales surprised to the upside, which is something we're going to talk about in a bit more detail, because you have to think about how are retail sales calculated, and is it by volume or total value? And it's actually by value. So the question is, well, did prices go up and it was still a volume problem? So these are things that we're going to go a bit deeper into to kind of unpack what does retail sales mean, which is again kind of pointing to why we think that we either drift a little bit to the downside, but stay relatively flat as we go through the remainder of Q4. And this is just going to look at some specific data points, which is why we had a mix, because the Philadelphia data was better, but as we look at U.S. Empire manufacturing data, so here you can see that there was an increase of 10.5, which again is positive, but the estimates were for 14. You look at U.S. jobless claims, the estimate was for a new 825,000. It was new 898,000. Continuing claims was slightly better. 10.55 was the estimate. We came in at 10.01. Then we look at retail sales. Now, this retail sales was where the estimate was for negative 30 basis points, and we actually came in at a positive 1.4, and that's looking at the control group. And then U.S. industrial production, the estimate was for negative 50 basis points, and we came in at negative 63 basis points. Again, slight to the downside. So the economists are still saying that the consumer has put away about 14.1% of disposable income this August. So the idea is that even if we don't get stimulus, the reason why we're seeing some of this pull through is people are pulling from savings. The question is, how do people feel, if you will, if we talk about Michigan sentiment, and as we start to look at what are some of these reports saying, and what are people thinking, and it's actually getting a little bit worse, which is concerning. And so even though they might have savings, it doesn't mean they're using those savings. And that's why when we look at what did people do with that extra $600, as we keep talking about, it was at the higher level, it was kind of squirreled away, which is kind of keeping us in this level. And without a new push for stimulus, we're just not going to have the holiday season that I think many expect. Now, as we look at in terms of, what's happening at the housing side, September housing starts were weaker than expected, but still 1.9%. So it was still positive, but it was still slightly below estimates. So the increase was 1.42 million, but versus a expectation of a 3.5%. So instead of it being 3.5%, it was 1.9%. But at the same time, it was negative 6.7% before. So, and then building permits were surprised to the upside of an increase of 5.2% versus an estimate of 3%. So again, you're starting to see those increases where you saw a little bit adjustment in terms of private housing starts, still above expectations. Still below estimates, but still positive, but those permits continue to roll. So now the problem is going to happen with if you think about the stimulus bill. So January 1st of next year, the moratorium on evictions goes away. So now, can that be extended? Sure, that can be extended. The question is going to be, do you get a surge of evictions at the same time you get the construction being completed, and those home buyers that surged out at the beginning no longer there? This is where we're starting to see these issues of what does it look like going forward. And unfortunately, we think that housing, even though it's a bright spot right now, could become an overhang in 2021. And is more likely to do so. And so here we go in terms of solid the starts. So new single family homes is at a 13-year high if we just look back in time. And multifamily housing starts, now it's down, but again, if you just look at where we are, we continue to kind of see this average, and the trend remains to be relatively stable at these levels. So not only are we getting new single family housing starts, so again, coming full circle to, if we go back to the first chart, when we look at housing units started by structure. So now we have the U.S. single family homes moving to an all-time high, 13-year high. You have multifamily housing starts remaining robust. So we have, again, construction increasing across the board, housing starts increasing, and then we have new permits. And again, when does this supply really come back into the market? And if you think about that, when does that slowdown actually happen? Well, HOMEBUILDERS market index has reached a new high as going back to essentially 1985. So when we think about the overall market, home builders feel great. They see obviously mortgage rates remain low. We're going to be at 0% federal funds rates, or 0.25%, whatever you want to call it, for essentially in perpetuity if you listen to any of the central bankers. So free money for everyone, which is going to keep mortgage rates low. Now, we know that the banks aren't lending to the same degree, as we've talked about with non-performing loans increasing, an issue in terms of job security and what you have to post as collateral, or show as collateral, or show your income statements, which again is going to be, just because it's cheap doesn't mean they're willing to do it. But people still feel good about it. And that's why we see those permits increasing, the construction going along the way it is, which is going to be, well, what does 2021 look like as do people move back into the urban settings if there is a vaccine, or people feel better about herd immunity, and all of a sudden some of these housing starts essentially fall by the wayside, or have to be, or are fully underwater and have to be resold. And then what happens with an increase in eviction notices? Does that shift in terms of just increasing total supply, again, depressing housing prices, which continue to trend higher essentially month over month? And with all of these headwinds, if we talk about, COVID cases increasing, the presidential election uncertainty of, will there be a peaceful transfer? Who will win? How long will it take to count the mail-in ballots? Fund managers raise stock holdings to one of the highest levels in years. So clearly fund managers have no fear, which means if there's a surprise, obviously there could be some capitulation to the downside. But this is something interesting to watch if you consider just fund flows, because even though we haven't had stimulus, we've had about 3% get added to the market based on when Trump said that there was going to be no stimulus till after the election. Then he said, "Oh, just kidding." Then from that point there was about 200 handles, or let's call it 3.5-4% added to the market. And this is where we can kind of see what those fund flows look like. So that's going to be something to watch, especially as we go into election, if people pare back some risk or maybe start buying some puts to try to offset, because even the put call ratio is moving in the bullish direction, which in the last time that happened, we had a big sell-off. So it's something to watch, which we'll keep talking about, as we go forward.